value of the US dollar USD is not fixed, and it fluctuates continually in foreign exchange markets. When people say the dollar is decreasing or weakening, they mean it is losing value relative to other currencies or a basket of currencies. There is no single cause. Multiple factors interact. Below is a comprehensive breakdown of why the dollar might be weakening now or over a given period, along with general principles. Basic principles. What drives currency values? Before diving into current factors, it helps to understand the what-why behind currency valuation. Some fundamental determinants include 1. Interest rate differentials, monetary policy. If US interest rates are lower or expected to go lower relative to rates elsewhere, fewer investors want to hold USD-denominated assets, putting downward pressure on the dollar. 2. Inflation, purchasing power. If US inflation is higher than elsewhere, the purchasing power of USD erodes faster, reducing demand for it, all else equal. 3. Economic growth and expectations. Strong economic growth attracts foreign investment into equities, bonds, etc., increasing demand for USD. Weak or slowing growth reduces that attraction. 4. Trade balances, current account. If the US runs large trade or current account deficits, it implies more USD flowing out to pay for imports than coming in from exports. Over time, persistent deficits can weaken the currency. 5. Fiscal policy, government debt. High government deficits and increasing public debt can undermine confidence. Investors may demand higher yields, raising risk premium, or reduce exposure to US assets. 6. Global safe haven status, capital flows. The USD often benefits from flight to safety during global shocks, but if global risk sentiment improves, capital may flow out of dollars toward riskier assets. 7. Expectations. Speculation, sentiment, traders' expectations about future policies, macro variables, central bank actions, or political risk can cause large swings in USD strength or weakness. 8. Alternatives and de-dollarization trends. If other currencies, e.g. euro, yuan, or alternative financial systems are seen as more attractive, some reserve or transaction demand for USD may diminish. 9. Intervention. Foreign reserves, central banks or sovereign wealth funds may buy or sell USD as part of reserve management. This can influence USD supply demand in the short term. 10. Relative moves in other currencies. Since exchange rates are relative, weakness of the dollar may also partly reflect strength in other major currencies, e.g. euro, yen, or risk-on flows into them. What's happening now? Why is the dollar weakening in 2025 or recently? Below are key factors that are often cited as contributing to the recent USD weakening. Some are specific to current US and global conditions, others are structural. Factor, explanation, evidence, risks, feedbacks. Expectations of Fed rate cuts, looser monetary policy. Markets are anticipating that the US Federal Reserve might reduce rates to support growth. Lower rates tend to reduce the yield advantage of USD assets. If inflation remains sticky, the Fed may delay cutting, which could reverse some weakness. Slowing US growth, weakening outlook. Analysts expect US growth to slow, which reduces the relative attractiveness of US assets. Morgan Stanley, for example, lowered growth forecasts and sees weakening. Morgan Stanley, if a growth surprise or stimulus occurs, sentiment might reverse. Large fiscal deficits and rising debt. The US government is running large deficits and debt levels are mounting. This can erode confidence in the currency. Econofact.org, if markets begin demanding higher yields, borrowing costs rise, creating a negative spiral. Policy uncertainty, credibility concerns. Policy shifts, unpredictable tariffs, or doubts about central bank independence reduce investor confidence in holding USD assets. Al Jazeera, if policies stabilize, sentiment might improve. Reduced foreign demand for US assets, if foreign investors, sovereign funds, central banks, reduce buying of US treasuries or assets, that lowers demand for USD. CIBC notes that the US dollar is vulnerable due to elevated current account deficits and weaker appetite for US assets. CIBC, if US yields become very attractive, foreign demand could bounce back. Weakened safe haven appeal. In periods of global risk-off, the USD often sees demand. But if global sentiment improves, or if other currencies/investments become more attractive, some capital may shift away from USD. Sudden global distress could reverse the flow. relative strength of other currencies, the euro, yen, or other major currencies may gain strength, which in turn shows as USD weakness. JP Morgan, if those currencies weaken or face their own troubles, USD could bounce. De-dollarization, changes in reserve behavior. Over time, some countries are trying to reduce dependence on USD in reserves, trade settlement, or financial systems. This reduces structural demand. J. Morgan, but de-dollarization is gradual and USD still dominates global reserves. Valuation overshooting corrections. After periods of USD strength, markets may correct and allow a depreciation to a more balanced valuation. Some analysts believe USD was overvalued. CIBC, short-term overshoots can reverse. To cite a few specific articles, Investopedia notes monetary policy, inflation, demand for the currency, economic growth, and changes in export-import dynamics as causes of depreciation. Investopedia, JP Morgan argues that US growth, rising deficits, policy uncertainty, and changing capital flows, rather than just interest rate differentials, are important drivers behind the 2025 dollar weakness. JP Morgan Stanley highlights that US assets may seem less appealing to foreign investors, and import price increases could increase inflation pressures. Morgan Stanley, Al Jazeera links a sell-off to unpredictable, unfunded economic policies, which strike at USD's safe haven role. Al Jazeera interplay, feedback loops and nuances. The factors are interdependent, e.g. if interest rates fall, that can lead to weaker growth, which further weakens the dollar. Markets often react ahead of fundamentals. Speculation or expectations about policy changes can move the dollar even before those changes occur. The US dollar is still the global reserve currency and is deeply embedded in the world financial system. That exerts a stabilizing force. Because exchange rates are relative, a dollar weakening often reflects strength or optimism elsewhere, Europe, Asia, etc. USD dollar index, recent and historical moves. The US dollar index, DXY, which tracks the USD against a basket of major currencies, has been under pressure in 2025. Investopedia, in the first half of 2025, the dollar index fell about 10.8%, which is one of its worst starts to a year on record, worst since 1973. MarketsBusinessInsider.com. Some sources estimate an 11% drop in the first half of the year. A-Invest, at times in mid-2025, the dollar hit its weakest point in 3 years, trading around 98.6 on the DXY scale. Investopedia, over the past 12 months, the USD is down by several percent, depending on specific index. How to push the US dollar higher, plain list with why it works. Here are the main levers who can act and market forces that tend to increase the value of the US dollar, USD versus other currencies, with a short explanation and the main trade-off for each. 1. Higher US interest rates. Federal Reserve. Why? Higher real nominal yields attract foreign capital seeking returns, boosting demand for USD. Who? Federal Reserve monetary policy. Trade-off. Slower domestic growth, higher borrowing costs, possible recession risk. Quantitative tightening, shrinking the Fed's balance sheet. Why? Reduces liquidity in markets and can raise long-term yields and dollar demand. Who? Federal Reserve. Trade-off, similar to higher rates, tighter financial conditions. 3. Stronger US economic growth, productivity. Why? Growth raises expected future returns on US assets and demand for dollar-denominated investment. Who? Private sector. Fiscal policy, government can support via investment. Trade-off, growth policies can raise inflation if overheating occurs. 4. Lower inflation relative to other countries. Why? Preserves purchasing power. Markets favor currencies with stable low inflation. Who? Fed, via rates, fiscal policy, supply-side policies. Trade-off, very low inflation can be associated with weak demand. Improved fiscal position, smaller deficits. Why? Lower government borrowing needs reduce issuance of treasuries and can support confidence in USD. Who? Congress, Treasury. Trade-off, requires spending cuts or tax increases. Politically difficult. 6. Large capital inflows, foreign investment into US assets. Why? When foreigners